G'day guys, Josh here. Welcome to another episode of Financial Fruits, episode 15. It's going to be about risk insurance again. It's going to be finalizing the income and trauma sections as well. Just first thing to talk about is income protection. Income protection is a bit of a meaty topic. So, by the way, before we go into it, of course, it's not financial advice. I'm not trying to promote any product to you or trying to recommend any product to you at all. Anything mentioned in this is just purely for illustration to make you understand this. I know a lot of influencers say this and then be like, buy Dick Dork or whatever it is, coin or whatever it is, but this is just purely educational purposes, and I'm not trying to sell any sort of product to you. So income protection is a bit of a meaty product. In Australia, a income protection policy can be owned in and outside of super. Super's a retirement product, so it can be done that. It is the premium is tax deductible inside and outside because it is protecting something you generate income from. Unlike TBT and life, where you're not generating any income from it, it's more of a capital expenditure. Income protection is to protect your income, so you're all fine and Gucci there. Next up is going to be what it protects. So income protection is generally paid per month in cover. So say you can get 7,000 per month, for example, and it is limited to 70% of your income and 80% if you want super contributions. We'll just put it super whatever. Okay, cool. We'll just put that there because we're getting to the end of the thing. So generally, if your income is under that 70%. Actually, no, you know what? We'll just explain that later. So there's two types of income protection you can get: is agreed value, which is an old policy, or indemnity. Indemnity is becoming more of the norm because it is cheaper for insurance companies. Basically, this is the income protection policy is the biggest insurance company's expense, so they're trying to reduce it at the moment. So agreed value is that at time of underwriting, which is when they do all medical checks and stuff like that, you need to prove that you earned that amount, okay? So if you're trying to go for like 7,000, let's just say 5,000 per month policy, okay? And you earn, let's just say 100,000, okay? You need to prove that you earn 100,000 first of all via pay slips, stuff like that, okay? Because if you don't, then they won't give you the policy, okay? Indemnity is different. Indemnity is that you must prove your income at state of claim, okay? So when you claim, so you need to prove that you have earned 100k before you became disabled. Okay, so that's the two types of different policies: agreed value and indemnity. Now, be aware with income protection as well with payment. Income protection payments only are offset by any sick leave and sometimes workers' comp that you receive. Okay, so let's just say you get income protection and you've got 60 days sick leave. They use the 60 days sick leave first before they start paying you. Okay, that sort of thing. Okay, that's just an example that's not entirely correct because we're going to get to the next subject to talk about it, but that's what it is. So we've gone through the income protection as a cover amount, which is roughly 70% of your income, 80% if you want super. We've gone through the policies of agreed value and indemnity. Now I'm going to go through the intricacies of it, called a waiting period. So waiting period for income protection is how long until you get your cover amount / benefit. And generally they can be 14 days, 30 days, 60, 90, 180, 365, and 2 years, okay? So that's the general waiting periods, okay? So basically, if you didn't get the 2-year policy, you're going to have a whole goddamn load of sick leave up your sleeve, basically, as well. Now, for these waiting periods as well, it gets cheaper the longer your waiting period. And also, the insurance cover payments are made in arrears, okay? which means that a 30-day period is actually 60-day period, okay? So be aware of that because they pay it monthly. So you get 30 days, you claim, 30 days, claim kicks in, your first paycheck's 30 days later, okay? So be aware of that as well. Keep that in mind when you're looking at it. The next up is the benefit period. The benefit period is how long do I receive my cover for, okay? Generally, there's 2, 5, age 65, age 60, age 65, okay? Those are generally, they're not all the periods, but generally what the period are. So you can have 2 years, 5 years, age 60, age 65. Some occupations cannot get age 65, age 60 and age 65. Most notably truck drivers, okay? Sorry for calling you truck drivers out in my YouTube community, but that's the one occupation that I know generally gets screwed by this. But generally most office jobs you can get to age 60 and age 65 pretty easily. Truck drivers, stuff like that, can get 2 years, 5 years, that's pretty much it. Now with the benefit period, there's no benefit period arrears or anything like that. You basically receive the benefit until you turn to age 65. However, some policies as well, by the way, they do check on you, do annual reviews, or change their definition from own to any. Sometimes it's even from to after 1 year, 2 years, could be more, okay? Insurers don't want to be paying you. Okay, we'll just delete this. We'll delete the above one here, so you guys can screenshot it quickly as well. Actually, you know what? We'll just delete this to bump it a bit up. So you can see here that basically, I'm going to tell you right now, just because you get a policy to age 65 and you think, oh man, injured my leg, never going to walk again, going to get my income protection payment to 65, the insurers will do anything in their power to make sure they don't try and pay you, okay? I'm just going to be plainly honest, okay? So if you can get a job, and you feel like you can mooch to train for a bit more, I'm just going to tell you for a rude awakening, that probably is not going to be the case, okay? The insurer will find a way to not pay you, especially if you can go out and work, okay? So that's the thing you got to watch out for as well. So just because you get it doesn't mean you're going to have it forever. You will always you should always aim to go back to work in some capacity if you can. That's just the feature of the income protection policy here. So with income protection generally should be one of your main policies that you keep. In the long term. And the reason for that is that the income protection's goal is to maintain your lifestyle until retirement, generally, okay? Generally, but retain your lifestyle, for that, period. So whether it's for 2 years, 5 years, until 60 and 65. That's what it's meant to do. And then after you turn, 65, your retirement product kicks in and funds your retirement kind of thing. Okay, so it's like a system. It's basically like, you hit 65, the share flings up, go into your super. Okay, you can access your super now. That's what the income protection is designed to do, where it will pay for until you become old, then your super kicks in, and then the age pension kicks in, and that's how your income protection keeps going, basically. That's the main aim for it. There's no real buy-sell agreements in there as well. You can get income protection things over other people and key person stuff, where it's a different type of income protection. You can get key person and business income protection. I don't know what's called exactly. And that just replicates or recovers the lost income from losing a key person. So let's just say, for example, you're a small business owner of, say, a team of 20, and they lose you, and you're the boss, and you do a lot of the negotiating stuff like that, and you have to hire a person to be in your position. You can recover the lost wages from you being out, or lost revenue potentially as well. Let's just say that you sell stuff and that you have a pretty decent quota, since you're not there anymore, that you don't earn too much. You can also replace that income as well. So that's the sort of policy you can have out as well. And that's a pseudo income protection policy. That's how it's used for business. There's obviously no buy-sell agreement with life and TBD, where a person can buy the business out with their proceeds that they have over you. That's it's a different sort of policy as well. Now you're gonna be thinking, what's the taxation of income protection policies? Because we talked about it with buy and sell agreements that they can have some capital gains associated with it. But with income protection, all the cover that you receive, let's say you receive 70 grand, is taxable. Okay, so it goes into your tax return and you pay tax on it. Be aware that the insurers will hold the payee for you. Okay, so don't worry about too much. Okay, the insurers will hold the payee and be like, nah, don't worry about it. Now, the things to like really look at for income protection policies is, first of all, is look how much sick leave you have. This will probably determine the waiting period. Any passive income you may have, and your living expenses. Generally, you should max it out. Okay, you should 70% it. Okay, not advice, but generally you should, because 70% of your income is generally spent on expenditure anyway. What else? How long do you need it for? And most of these will be age 65 questions, most likely. But for truck drives, so like that will be the maximum period you can get. And also as well, the last question, which will be very rare: when do I cancel it? And I'll be in a situation where your passive income is able to sustain you if you're unable to work. Okay? Let's just say investment portfolios, lots of sick leave, you have lots of savings. Okay? Like, for income protection to be like this, it is incredibly difficult, okay? Income protection is probably going to be one insurance that you keep for life, okay? Life and TBD, you will eventually drop when you have no debts, but like life and income protection is probably one you'll be keeping for life, okay? And I think we talked about in the previous video about leveled and step premiums. The income protection may be the one you want to look at step level premiums for, because you'll be keeping it from the start to the end. Anyways, that's going to be it for income protection. Let's get to trauma, okay? So trauma is basically they made trauma because some conditions didn't qualify for TPD. So stroke, heart attack, cancer, if they were mild, they would knock you out of work, but you wouldn't get TPD or IP because obviously the waiting periods are too short. Let's say you recover 7 days from a heart attack and you're back at work. Who pays the hospital bills? Hence, this was made. So basically, generally the 3 things that are more common with trauma is stroke, heart attack, cancer. So this policy is to provide a lump sum to pay hospital bills or any short-term debts to if you suffer from one of the above conditions. There are more conditions to this in trauma. It's in your policy document. Check it out, okay? I'm just going through the 3 most common ones caused. That is roughly about 70% of the claims, okay? This doesn't mean you should get a trauma policy. This just means that, I'm just telling you statistics to back up what I'm saying. So that's what trauma is there for. Now, trauma can be a long-term insurance, mainly because its main goal is to just pay medical bills that come up. Now, some people may say, what about public health insurance and blah, 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 and other areas? Well, they do pay for some hospital expenses, but not all, okay? There's a gap payment, and that's where trauma is designed to cover. That's why I recommend trauma policies to some of my clients, is that some of the public health stuff and private health stuff doesn't cover some of the surgeries that you may take. You have to pay for that yourself, or pay a gap payment yourself for it as well. So just be aware of that, is that not everything is completely free in the public and private health sector. Sometimes you have to pay, and sometimes you're losing income because you have to relax and take a break and stuff like that. So this is where trauma can be quite useful. Now, trauma can be a long-term insurance because you always need potentially a backup plan for extra money, just because of a hospital visit. However, the main reasons why you would get into a trauma insurance policy is to protect, a blip or a small event that happens which disrupts your income. That's pretty much what a trauma policy is set up to. So anything that disrupts your income or increases expenses, or disrupts your income or increases expenses via hospital bills. The reason why you would cancel a trauma policy, is that you have an emergency savings to afford this with combination of private public health cover. So be aware of that as well. Okay, be aware of that. Generally, trauma insurance is another one that you would cancel before income protection as well, because it gets to a point. Let's just say, for example, get to a point where you can utilize an offset account to pay for it. You've got enough savings outside of super to do it. You can access your super, and you've got enough savings in there for your retirement and any little blips that come out in the way as well. So you've got the You've got the assets to do so. So canceling a trauma policy should be relatively done, like, generally, when you have a safe asset pool and savings to pull from if you're unable to, if you go to hospital. Generally, you want to look at the average hospital cost of all the main factors or main things that you can claim on. So basically stroke, heart attack, and cancer, and make an ideal estimate from there for your cover amount, for your default, and then add, like, credit cards and stuff like that, things that need to be paid in the short term to get roughly how much trauma you need. Trauma is a very expensive cover. And this is because it is very easy to claim. Just be aware of that as well, okay? Anyways, guys, that's going to be probably it with trauma, okay? And the rest of the covers as well. Hope you guys learned a lot. I know I did more on income protection. Trauma is a very simple cover, so it's not simpler than life, but it's a relatively simple cover. But as you can see here with trauma, check your product information guide as well. That's what you need to do with all insurances. Make sure you check your product guide. Make sure you know what you're insured for and stuff like that as well, and how much you're insured for. Overall, with insurance, you need to just take a hard look at yourself on what needs to be covered, what needs to be paid off. Don't, insure yourself for God amount of figures, because you're going to end up impacting your retirement overall if you try to go for some pie in the sky numbers. You want to try to be very specific, and probably want to just knuckle down on why you need this insurance and what needs to be paid and why. Anyways, hope you guys enjoyed it. We're going on to a new topic after this, and hope you guys can join me. See you guys later, and have a great day.